Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. I want to take a quick look at Rockwell Automation, ticker ROK. These guys just had their Q1 earnings call. Not too great, missed by about 50 million on the revenue side, 2.1 billion on an estimate, 2.05 on an actual. And then on the adjusted EPS side, they were missing by about 60 cents. So kind of a miss on both sides. Margins were pressured, revenue was pressured, so the market reacted unfavorably, taking the stock down about 17% in that one day alone. The stock is back up a little bit this morning, but overall down about 15% in the past 5 days. And Rockwell Automation, if the name is not a clue, is in the industrial automation space. You may think industrial automation these days is all robots, 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 but it really isn't. It's still very much those old assembly lines, but just made in a more efficient way. They are making the programmable logic computers that kind of control the assembly lines themselves, control the manufacturing process, makes it better. And they make all of the stuff that goes into the assembly line as well. So it's the hardware and also the software that controls all of those items. So if you're thinking conveyor belts, switches, sensors, buttons, PLCs themselves, the software that runs it, Rockwell Automation is doing it. They're not the only one in the space, but they are a pure play in the space. You can talk about Emerson, you can talk about Siemens, you can talk about GE. All of those companies are doing this, but they're also doing a bunch of other stuff. So if you want to own industrial automation and digital transformation, Rockwell is kind of the one pure play in the space, and they're doing it worldwide, so not just in the United States. And if you do want to talk about robots and you think that's the future, they've made some acquisitions in the past couple of years that have kind of tackled that. You can kind of talk about ClearPath Robotics, one of the companies under their umbrella now, sort of doing the thing that you think about when you think about warehouses and little robots moving stuff around for you, helping with certain tasks and helping companies tackle labor shortages of that nature. So they're there, but it's just not a big part of their business just yet. But in the future, it certainly might be. So yeah, the earnings missed for the quarter. The nice thing for investors, the silver lining there, is that they didn't adjust their full year outlook. They're still expecting the same growth that they gave in their Q4 earnings call guidance, 0.5 to 6.5% growth. Some of that coming from currency and some of that coming from acquisitions. And one of the things they've done since about 2017, if they've kind of been on an acquisition spree, they do generate a decent amount of free cash flow every year, good free cash flow conversions from their earnings. They use that money to pay down debt, buy back a few shares, not too many in the last couple of years, but also acquire other companies to drive better growth. But it's not a meaningful source of growth in the last couple of years. You're talking about 1 to 2% any given year. But I think what they're trying to do is they're trying to obviously expand their business into more automated lines, more futuristic lines, obviously with acquisitions like ClearPath Robotics, but also acquire businesses that they think might be a small contributor right now in terms of revenue, but in the future are going to be a much bigger contributor, which is kind of what they should be doing, and kind of why I'm kind of interested in this company. And then on the operating margin side, no adjustment there, still expecting 21.5%, and they reaffirmed their adjusted EPS range from 12 to 13.50. They didn't specifically outline it here, but I believe they did downgrade their non-adjusted EPS by about 25 cents or so, which is a bit of a negative as well. And in general, even though their outlook hasn't really changed that much, I think as investors look at their Q1 miss, sizable on the bottom line, sizable on the margins, they're worried about whether or not they can actually achieve this full year outlook. And their explanation for why the miss happened is that as you look at their performance in the last couple of years, this is a company that benefited quite a bit from the pull forward demand of the pandemic. A lot of industries got access to low cost of capital, and they used that money to improve their businesses. And they went to companies like Rockwell for help with automation and efficiency upgrades. Certainly great for Rockwell, but now that that cost of capital is coming up, as things get more expensive to fund, less and less companies are doing these improvements, and that's impacting the orders for a company like Rockwell. And essentially what happens when stuff like this happens is they kind of overbuild. Rockwell overbuilds on inventory. They send that out to their distributors, and now their distributors have a bit of an over allotment of inventory, and until that sells through, they're not really going to get as many orders as they would have in the past. So they're thinking that Q1 was a factor of that. Too much inventory in their external channels, their distributors not buying as much as they expected. But as that inventory flows through to the end customer, their distributors are going to need more and more inventory. They're going to come to Rockwell, and Q2, Q3, and Q4 should be better as they kind of work through that overflow on inventory to their distributors. And as that settles down, they're going to sell more stuff to those distributors in future quarters, and they feel like they can achieve their guidance that they gave in Q4. Now, the problem is that this is a stock that the market has applied a certain multiple to because of their growth in the past couple of years. And this has been common in a lot of industries that I've looked at. Basically, if you're growing at 10 to 15%, the market's going to give you a certain multiple. Now that you're growing at 2 to 3% for the next couple of years, that multiple has got to come down. And this company is becoming more of the company it was in 2016, 2017, 2018, and 2019 than the company it's been in the last couple of years. So the market's giving it a really good multiple the last couple of years, but now that's changing. That multiple's coming down, and I look at the valuation, that's certainly going to come into play. So if you look at the valuation here, free cash flow here is certainly in that 5% range after that drop, which is pretty good. That's on a levered basis. On a non-levered basis, it's closer to 4%. But historically, if you go back to those 2016, 2015 years, this is a stock that's been in that 5 to 6 to even 7% range. So kind of coming back down to where it should be based on their future growth. And we'll look at that in a second, looking at the valuation. First, disclaimer. Video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence. So as you look at the valuation again, free cash flow yield on a 2023 actual basis is close to 4% on a 12-month basis. Next 12-month basis, based on the assumption we have here, is closer to about 4.7%. So not too bad, but I'm thinking this is a company that should be in that 5% range as it was on a historical basis. This is a company that does buy back some shares, but if you kind of look at what they've done in the past couple of years, they haven't bought too many, which I think is generally kind of a sound strategy. If they didn't think this growth and this market reward was going to last forever, it didn't make sense to buy back a ton of shares. But they did buy back a good amount of shares in 2018 and 2019. Then in 2020, 21, 22, and 23, as their stock price soared, they kind of paused that a bit. And what they did is they acquired more companies. They took on some debt at low interest rates, and they acquired some of these companies that are helping them grow into the future, even if that growth isn't showing up in the financials just yet. They do pay a dividend. It's about a 2% yield at today's prices. They've grown that at about a 5% clip. I'm going to continue that into the near term as well. As I look at their actual projections and their assumptions, I'm going to be a bit more conservative because I think, given what we've seen in Q1, I think to expect 3 to 4% growth in the next year or two might be tough to hit. I do think they can improve their margins. They're working on improving their margins. They have a long-term margin goal that I'm certainly not concerned about them hitting, but I do think that their growth is going to take a bit of a pause in the next couple of years and then return to slightly bigger growth, maybe in 26 and 27 and 28. If you feel differently about this company, you can certainly play around with the spreadsheet. I'm going to leave a copy down below. Just hit file, make a copy, and play around with it as you'd like. So I'm expecting slight growth for the next couple of years, margin improvement, kind of hitting a margin top of about 16.3%, which based on their guidance, kind of where they're going to be, maybe in that 16.5%, 17% as a max. So there's potentially some upside there. I'm assuming they're not buying back a ton of shares. I think this could change though. What they've been doing more recently is just using the free cash flow that they generate to not only pay a dividend, because their payout ratio is only about 40%, but also to acquire other companies without building up debt too much. Their balance sheet looks pretty good, only $3.2 billion in debt. Some of that is capital leases as well. So if you kind of go back to their balance sheet and look at what it looks like, it's not too bad. $439 million in cash. $2.8 billion in debt. But when you talk about a company that's got almost $2 billion in EBITDA, their debt to EBITDA is not too bad at all. And this is a company that has generated free cash flow and net income during the 2008 recession, during the 2020 mini recession. Uh, so this is a company that's relatively steady, and that's why the market rewards it with a pretty decent multiple. So as I look at this, am I being too conservative on the multiple I give it? I'm kind of weighing more heavily towards the 5% free cash flow yield, a little bit at 6%, which is kind of where they've historically been when they've slowed growth like this, and then a little bit towards the 4% range in case there's some upside and the market values it where it's currently being valued. So as I look at it this way, um, I'm kind of expecting a return of about 6.6% from today's price, which isn't too enticing. What can they do to really spice that up? Well, they could certainly buy back more shares. They have the money to do so. If you look at what I'm projecting at a 10% buyback, it's more in line with what they've done in the past couple of years. Talking about anywhere from 100 to 180 million dollars in buybacks any given year. But if they go back to what they've done in 2019, 2018, using more of their free cash flow towards actual buybacks, they could certainly buy back a lot more. Even 40% of their overall cash flow drives the overall return up quite a bit by at least 1% a year. Because if they feel like the stock is undervalued right now, which I don't necessarily think it is by a huge margin given their growth potential in the next couple of years, they can certainly buy back more shares. For me, though, if I look at it this way, if I look at these growth assumptions, and these are kind of minor growth assumptions, a bit depressed in terms of where they have been the past couple of years, but probably in line with reality. And expecting a 10% return, which would really be a 12% return given the dividend yield, I get a fair value of about $202. And maybe that's a bit conservative. Maybe for a company like this that's consistent, that has stood the test of time, that does relatively well even during the recession. So in 2008, while their revenue did drop by about 25%, they were still positive on the net income side. They did not cut their dividend, although they didn't raise it. So maybe an 8% target return is good enough for you. In that case, you're talking about a $221 fair value. Now, the upside here would be that, yes, this is a poor year, but they've already committed to a long-term growth target of about 6 to 9%. So let's say they're going to grow about 7% in the next couple of years. Now that takes you to a fair value at a 10% return of about 228, about 250 at an 8% return, which is right around where they are today. So really, for me, in order to feel good about buying this stock today, I'd really need to get this in the $200 to $220 range, or in order to buy at today's prices, I'd really need to believe that after a period of slow growth this year, they're really going to get to that 7 to 8% growth for the next couple of years and on an ongoing basis, which I just don't think is really realistic given what they do. And given the fact that cost of capital is high now, and other companies are going to be less willing to kind of update their automation and industrial factories as often as they would in the past couple of years, or as quickly as they would in the past couple of years. Now, they did do a pretty decent job of making some acquisitions in the last couple of years. Is that going to help them grow faster? Maybe, but it's hard to path that out right now. I think their robotics investments are going to take a while to play out. Right now, they're really kind of this, industrial behemoth that might be too dependent on what other industries are doing. And as those industries slow down, they're also starting to slow down a little bit as well. And if you kind of think about what happens in a potential recession, what happens in a potential slowdown, could they actually see negative growth in the next couple of years? I think that's possible, maybe even probable, because we are kind of seeing an economy where cost of capital is high, where companies like this that are maybe in a way cyclical because they're dependent on what other industries are doing in a big way are going to be hit kind of severely when an economic slowdown happens. So that worries me a little bit as well. That's why when I look at this, I kind of want to build in a little bit of safety margin. I want to be a bit realistic about these scenarios. Is this a company that should be getting a multiple that's as high as something like Google, for example? Because right now it's getting a 4% free cash flow yield, and I think Google is probably getting a 4% free cash flow yield. Is that actually real in terms of what a company like this should be getting, right? So their free cash flow yields are not that disparate even though Google is still growing at 11%, they just had their earnings as well. Completely different industry, obviously, so it's maybe not the best comparison, but this is now growing at 2%. Margins have been pressured in the latest quarter. Are they going to continue to be pressured in the rest of the year, or are they actually going to be able to recover? So there's some worries for me here. There's some concerns about this company's ability to kind of move into the next phase of automation. I think they can certainly do it. They're one of the biggest players in the space. They've been around for some time, but there's certainly uncertainty whenever something like that happens, as you talk about. Well, the future of this space is robotics. If you feel that way, is Rockwell in a good spot to benefit from that? Or are other companies just doing it internally at this point? If you think about companies like Tesla, you think about companies like Amazon, these big behemoths that would otherwise potentially be customers of Rockwell. Well, we're just doing it ourselves. Is that a problem for Rockwell? Or can they just do well working with other companies, other smaller companies that don't do it in-house? And I think they can. I'm not really worried about this company going under. I'm just worried about this company moving into a phase in the next couple of years where the earnings are going to be a bit depressed, where growth is going to be slow, where the market is going to start looking at this company differently. And it's obviously already starting to do that. But if I want a really good deal on this, I'd probably want something closer to 200 and 220 bucks. That's kind of where I'm going to track this stock. If it gets there, it gets there. If it doesn't, it doesn't. I think this is a company that is a very solid company. So the market might just not let it get that low because they believe this is, a long-term compounder. They're going to use their free cash flow to buy new companies, grow, even if it's at a slower clip. The faith is there that this is going to generate $1 billion to $2 billion in free cash flow every single year in the next couple of years for the next decades. And if that happens, then this should certainly get a higher multiple, and that's why this stock has done as well as it has. If you kind of go back to, a price chart and go 10 years out, it's a 10% CAGR. If you go 18 years out, it's a 10% CAGR. So at this price point, is it also going to be a 10% return? To me, it doesn't seem that way. That's why I'm kind of looking at something closer to 220, 200 to 220, depending on what kind of long-term return you're looking for. But the market has done a pretty good job of actually recovering from, the stock rather has done a pretty good job of actually recovering from these kind of mini crashes. You can kind of see, hey, this was a little bit of a reduction in price in 2022 after the market corrected, after their earnings disappointed, but it recovered again. Now it crashed after their Q3 earnings call in 2023, but it recovered again. So now it's crashing after their Q1 earnings call in 2024. Is it going to recover pretty quickly? If it does, I wouldn't be surprised. But if it doesn't, this would be a stock I would really be interested in the low 200s. So that's my take on Rockwell. Really good company, really solid history. I think what they're doing is very important to the entire worldwide economy. They're not going to disappear anytime soon. So if you're buying it and feeling like you're worried about what's going to happen to this company 10 years from now, I'm probably not worried about that. But I do think I'd want a better multiple to get into this stock than what it's offered at today. So let me know what you think about Rockwell. I know it's not a super exciting company. They kind of do what they do. They're sort of in the background of a lot of these other big companies, but they are an important cog in the wheel. They have pretty good margins, decent growth historically, and as long as they can kind of consistently grow, even at a small clip, maintain their margins, and do a good job of smartly investing their money via acquisitions, they have the balance sheet to acquire something even bigger than they've done in the past couple of years. So maybe they do that sometime soon. But they do have to somehow spice up growth if the stock market is going to give them a multiple that's going to excite investors in terms of the long-term returns from today's prices. Because at 260, it's just an okayish investment in the 6 to 7% return range in my mind. But if you disagree, let me know down below. If you like the video, like it. If you're new here, subscribe and all that good stuff. Otherwise, thanks for watching and bye.